Welcome to the deep dive. If you're, opening your portfolio or just checking the news and feeling like the global market is just screaming risk off, well, you are definitely not alone. We've pulled together a really critical stack of sources today. We're synthesizing high-frequency data from Indian equities, major commodity futures reports, central bank policy, and some of those long-term global forecasts.
It has been a profoundly, just a tumultuous start to 2026. Our mission today is pretty simple. We're here to give you, the learner, a shortcut to being well-informed. We need to cut through the noise, cut through the panic, and really trace the actual cause and effect chain here. Are these huge market shocks just about the short term, the explosive geopolitical risks? Or are there deeper economic currents that might actually offer some reasons for optimism?
Okay, let's unpack this right away. Let's start where the pain has been the most acute, Wall Street. The first week of the new year delivered what some analysts are calling one of the most unsettling starts in recent memory. We're not talking about a gentle correction here. We're talking about sheer magnitude. The Sensex, India's benchmark index, fell over 2,000 points across just 5 trading sessions.
And that sharp movement, it translates directly into real value loss. In hard numbers, investors saw more than 9 lakh crore rupees. And for context, that's roughly, 108 billion US dollars just erased, wiped from the market cap in a matter of days. That kind of sharp correction doesn't just reduce wealth, it really shakes confidence, and quickly.
So with that level of systemic pressure, what were the specific market signals that just intensified the selling? What was the financial trigger?
Well, it was primarily fueled by sustained foreign institutional investor outflows. FIIs, as we call them. We're talking about the large foreign funds that hold really significant stakes in Indian markets. They were net sellers for 4 consecutive sessions, which culminated in this massive selling pressure on January 8th. And because these funds typically hold the biggest, most liquid stocks, their exit just amplifies the downside across the whole index.
And the technical picture, it just confirmed that bearish feeling instantly.
No, it absolutely did. The Nifty index fell nearly 2.4% that week. It formed a classic bearish pattern, lower highs and lower lows, which basically signals to traders that momentum is firmly down. And if you want a number on just how panicked the market got, the India VIX.
The fear gauge.
Exactly, the fear gauge. It jumped a staggering 16% in that same week. That's a huge spike that tells you volatility is in charge, not conviction. So technically speaking, if you're tracking the Nifty, support is now near 25,600 with major resistance, the ceiling, right at 26,000.
Which brings us to the core issue. The external driver that's dominating headlines and pushing this whole risk-off environment. Geopolitical tariffs and the threat of trade wars. And here's where it gets really interesting, because the single dominant trigger points directly back to U.S. President Donald Trump's rhetoric.
That's the consensus across almost every source we looked at. The market has been under this relentless pressure since the president signaled these potential sweeping tariff hikes on Indian goods. And the context is very specific. It's tied to India's continued strategic purchases of Russian crude oil.
And we're not talking about a slap on the wrist. The U.S. hinted at imposing truly punitive, massive 500% tariffs. 500%. That is not a trade adjustment. That is an immediate shutdown of market access.
Precisely. The magnitude of that number, that 500%, is what turns this from a trade dispute into a genuine geopolitical market shock. It's a threat to global supply chains, to trade flows, everything. And the tension here really stems from the failure of diplomacy. 6 rounds of talks between the U.S. and India since March have completely stalled, reportedly due to a claimed lack of direct engagement between Prime Minister Modi and President Trump.
So the immediate future of Indian equities is tied up in Washington politics, not just fundamentals on Wall Street, which is why investors are laser-focused on the big event to watch tonight, a U.S. Supreme Court ruling.
This is a huge and, I think, underappreciated factor. The ruling is about the legality of the sweeping tariffs Trump previously imposed under the International Emergency Economic Powers Act, the IEPA.
Okay, for our learner, what exactly is IEPA, and why are we suddenly talking about constitutional law in a finance deep dive?
Well, the IEPA, it grants the president broad authority to regulate commerce during a declared national emergency. Historically, it's been used for sanctions against, enemy nations. The challenge is that trade disputes don't really qualify as a national emergency in the way the law was intended. The implications here are enormous. If these tariffs are declared illegal, and many experts see a high probability of that, Washington might have to return close to $150 billion to importers.
Wait, $150 billion in potential refunds? That's an astonishing number.
It is, and for India, a verdict like that could spark an incredibly sharp immediate relief rally. India has been one of the countries hit hardest by the existing tariffs. If the legal basis for all of that just collapses, it removes this massive cloud of uncertainty overnight.
So what's the takeaway for investors trying to navigate this?
The consensus advice is caution, not panic. The underlying domestic economy is strong, but this geopolitical piece is just too unpredictable. Experts are advising long-term investors to avoid aggressive lump sum buying right now. Instead, stagger your investments. Buy into high-quality stocks based on fundamentals, but acknowledge the short-term political earthquake potential.
All right, let's pivot from that global fear to domestic policy, because India has been anything but passive. We have to talk about the RBI's decisive actions back in December 2025, what analysts were calling the double bonanza.
The Reserve Bank of India, yeah, they sent a powerful signal of stability to the market. This bonanza had two parts. First, they unanimously cut the policy repo rate by 25 basis points down to 5.25%. A standard rate cut, but important.
But the second part, that was the real game changer for stability, wasn't it?
Absolutely. The second part was a massive simultaneous announcement of a durable liquidity infusion. The RBI pumped roughly 1.45 lakh crore rupees into the system. That's tens of billions of dollars. It included open market operations and also a $5 billion USD-INR swap.
Why is that liquidity so important, though? Isn't a rate cut enough on its own?
It's all about policy transmission. A rate cut only works if banks actually have enough cash to pass those lower rates on to businesses and to consumers. By cutting the rate and injecting a huge amount of cash, the RBI basically ensured that financial conditions would ease, stimulating growth no matter what was happening with global risk.
And this whole proactive policy was backed by some very positive domestic numbers.
Completely. The RBI raised its real GDP growth forecast for FY26 up by a significant 50 basis points to 7.3%. And at the same time, they revised the inflation forecast sharply downward, 2.0% from 2.6%. And this is largely thanks to benign food prices, which have a huge impact on inflation in India. That combination, strong growth, low inflation, is the textbook definition of a healthy economy.
But despite the RBI's efforts and those strong fundamentals, one area has really struggled: the rupee.
The Indian rupee, the INR, has definitely taken a beating. It weakened nearly 5% in 2025, making it Asia's worst performer. And it recently crossed that psychologically important 90 per dollar mark.
What's the immediate practical impact when a currency crosses a symbolic mark like 90 to the dollar?
The immediate impact is on India's huge import bill, especially for energy. A weaker rupee makes every dollar of oil, coal, and capital goods that much more expensive. It creates inflationary headwinds and puts real pressure on company margins. It's a major economic stressor.
But the RBI's intervention did help stabilize things for now. So what are the two big external factors that will decide if the rupee can finally recover?
It really comes down to two things. First, the conclusion of that U.S.-India trade deal. Second, and maybe more critical for long-term stability, is India's potential inclusion in Bloomberg's Global Aggregate Bond Index. Just getting included could attract billions in capital inflows, as global funds would be forced to buy Indian government debt. That would stabilize the currency dramatically.
Let's shift our attention now to the broader global markets, specifically commodities, because volatility is really the key word there, especially in energy. Crude oil has been flashing completely mixed signals.
Yeah, we saw WTI crude prices fall 2% recently, based entirely on expectations of more supply. This was driven by the U.S. signaling it might roll back sanctions on Venezuela and Saudi Arabia cutting its prices for Asia. That's a fundamentally bearish signal.
But then just days later, prices shot right back up to two-week highs. We'll flip the script.
Geopolitics flipped it. The market repriced risk after a Russian oil tanker was hit by a drone attack in the Black Sea, and Iraq nationalized some major operations. It just shows you how sensitive the oil market is right now. Supply concerns are battling immediate conflict risks, so traders are bracing for more sharp moves.
So if we zoom out past the daily noise, the expert analysis seems a lot more optimistic for India, right? Specifically on oil prices.
This is a major insight. SBI Research forecasts the Indian crude basket to soften significantly, projecting it to land around $51.85 per barrel by June 2026. And this isn't just a guess. It's driven by an expected global inventory buildup. Basically, supply should outpace demand over the next 6 months.
And if that forecast holds, what's the domestic impact for India's economy?
The impact is overwhelmingly positive. It's a massive tailwind. That correction in oil could translate directly to a 3% appreciation in the rupee, maybe pushing it toward the 87.5 per dollar level. Plus, lower stable oil prices are projected to add a healthy 10 to 15 basis points to India's GDP growth.
Okay, turning to bullion, gold, and silver. They've slipped recently, mostly due to a stronger U.S. dollar and some very specific market mechanics. This annual index rebalancing.
That annual index rebalancing is a major short-term drag. Citigroup estimated billions of dollars in outflows from gold and silver futures just because of these reweightings. Simply put, big institutional funds have to adjust their portfolios, which forces them to sell. Suger saw exceptional volatility because of this, tumbling as much as 6%.
So is this the end of the gold rally, or is there still strong underlying support?
Oh, there is very strong structural support. Despite this near-term pressure, central bank buying is still aggressive. China's central bank, for instance, has extended its gold buying streak to 14 months. That steady demand, plus all the ongoing geopolitical risk, helped deliver gold its best annual performance since 1979 last year. The fundamental outlook is still quite positive.
So let's try and tie this all together. We've seen this brutal start to the year in India, driven by geopolitical fear, tempered by decisive RBI action, and backed by a favorable long-term energy outlook. So what does this all mean when we zoom out to the entire global perspective?
Well, if we shift to that global long view, the outlook is surprisingly optimistic. Cautious, but optimistic. Goldman Sachs is forecasting global stocks to return a healthy 11% in the next 12 months. And crucially, they expect these returns to be driven by fundamental profit growth companies actually earning more money, not just by rising valuations or, speculation.
That sounds like a much healthier, more sustainable market dynamic. So what phase of the market cycle are we in, according to this analysis?
The analysis suggests we're in the optimism phase of the cycle. This is the phase that historically follows that initial big rebound. But they caution that the dramatic gains we saw in 2025 won't be matched. This phase requires much more selective investment.
And for the learner looking globally, what should they prioritize in this optimism phase?
Diversification. It's key. We've hit a turning point. For the first time in nearly 15 years, the U.S. actually underperformed some major non-U.S. markets in 2025, Europe, China, Asia. That means investors can't just rely on the U.S. tech rally anymore. They need broad geographic exposure and a good mix of both growth and value stocks.
And speaking of tech, its dominance is supported by superior profit growth. But are we seeing an AI bubble like the 2000 tech peak?
The consensus, looking at the fundamentals, is no, not yet. Tech's dominance is justified by its profit growth, and valuations, while high, they just aren't as extreme as they were back then. But this focus on AI and efficiency is revealing a pretty surprising vulnerability in the U.S. job market that investors really need to watch.
Tell me more about that vulnerability. That sounds like a crucial structural shift.
It is a critical long-term factor. We're seeing this specific deterioration in the U.S. job market for college-educated workers. The unemployment rate for college grads aged 25 or older, while it's still low at 2.8%, is about 50% higher than its 2022 low.
That's a big directional change. And it's even more stark for the younger graduates, right?
Precisely. For the younger group, 20 to 24, that unemployment rate has climbed a staggering 70% from its 2022 low. It's up to 8.5%. This isn't your typical cyclical unemployment. This is a structural squeeze hitting the highly educated sector.
Why is that so important? How does it connect back to the geopolitical chaos we started with?
This deterioration, which could reflect the rapid rollout of AI and other efficiency measures, has massive implications for policy. If automation is thinning out high-wage jobs, it could have a huge negative impact on long-term consumer spending. And the structural weakness could force the Fed and other central banks to cut rates further than expected, not just to control inflation, but to fight technology-driven job loss and deflationary pressure.
That brings us to the end of our dive. We started in a place of pure fear. A staggering $108 billion wiped out of the Indian market because of a 500% tariff threat. But we tracked the RBI's steady hand, we looked at crude oil forecasts that promised significant economic upside, and we zoomed out to a global market driven by real profit growth.
What you've gained today is the ability to distinguish between the short-term, noise-like trade negotiation drama and the crucial, long-term structural forces that truly determine growth. Things like proactive central bank policy and the powerful force of technology. Context is everything.
And here's a final provocative thought for you to chew on. The U.S. job market data suggests that efficiency gains from technology, possibly AI, are hitting the highly educated segment particularly hard. If AI is already impacting the employment of college graduates, a group usually insulated from economic swings, how quickly will this emerging structural pressure force central banks globally to rethink not just monetary policy, but the fundamental relationship between technology, labor, and inflation? Think about that until our next deep dive.